Yeah, I think that it looks like we're gonna, retest. If I just look at the Qs, I own Apple, Amazon, the Qs, Coinbase, and some other names, but it looks like the Qs are gonna, on the direction to go back to that 318, 320 level, which is a little bit of ways from here. This market is all about the Fed, Scott, and when I think that people think the Fed is way behind, and we still have a really strong economy, that long duration risk assets, which are the Qs embody that. I think people are just selling those and saying until we have a better grasp on how far the Fed's going to raise, how much QT, and how high inflation is going to be, this is just still going to be, at best, a trader's market in the tech. But I still think there's going to be a tremendous amount of weakness. So you just got to sit through it because brighter days will be here, but definitely not for the next few months.
Now, Joe, Nvidia, now they come for Nvidia. Right, you talk about, I went through some of the big name declines over the last 5 days. Now they've come for Nvidia. Bear downgrading it today to neutral from outperform. Price target goes to 225 from 360. The stock obviously had come down substantially from 360, but nonetheless, here you go. I wonder if we, will end up looking back and say, okay, you get downgrades to the, if not mega caps, the soon to be, or right in the ballpark of mega caps, and what that means big picture, Joe.
Probably. I think this is an opportunity for an investor with a long-term focus, but it still doesn't feel good. It's maximum frustration, without question. Whether it's Nvidia, which I own, or it's Amazon, which I recently purchased, or Alphabet, or Microsoft, or Apple, collectively those four mega cap equities encompass 18% overall of the S&P 500. So it's incredibly frustrating. You have to react to that. I've had S&P futures on as a hedge against those four positions, not because I want to, because I have to. I'm defending against not losing money, but not losing as much money as possible. And here we are embarking upon earnings, and we're going to try and uncover the resiliency of the consumer and what margin compression is going to look like. This is a very difficult period right now, Scott, and I don't see it reversing anytime soon.
All right, so Steve Weiss, I thought Mike Santoli had a very interesting note that he sent around internally and approved my mentioning this on the air. He says, the market isn't nearly as weak as it looks today, with NASDAQ 100, semis, and energy all off 2%-ish, and everything else holding up okay. Too early to say that the salutary rotational forces again prevail as they did in all of 21, but makes this a less internally damaging 1% plus drop for the S&P. So we're focusing on, the thing in the bright lights, NASDAQ and NASDAQ 100, and that's where the carnage has been. But maybe inside, it's not as bad.
Well, that's today. I think you referenced today, but it is that bad.
I did.
Of course, you have Microsoft that's weighing on it and taking it down more than it should because it's getting hit. But to me, that's the issue. They're coming for the stalwarts. They're coming for the standbys, and not just attacking them on valuation, but attacking Microsoft on fundamentals, saying there's going to be a slowing of their growth in Office 360. So, look, I don't know whether that's true or not, but to me, look, people are still bullish, and I regard that as sort of like a backhanded bullish comment. Hey, it's not that bad while you're looking at another, 1 to 2% decline in the indices. So until people start saying that all the bad news is priced in the market, we've seen all the bad news without the realization that all the good news is also priced in the market. What dominates every conversation is the economy's still strong, the consumer's still strong. So where's the upside surprise? Here's the downside surprise. The market investors have been used to the Fed put. They've been used to 10% declines in a flash, and just as quick a flash, the market trading up and recovering. And that's just not what the reality is with the Fed on a very aggressive tightening cycle. And by the way, as part of their tightening cycle is the market coming down because that also removes liquidity from the economy. So look, I'd much rather be bullish. It's so much easier to be bullish, to be happy-go-lucky, snapping your heels, and all that.
Well, you're
but
describing
that's not
who
where
you're
I am.
describing.